And welcome back to another episode of Kent's Corner. We've got our market update. We had a big week last week. Last week was the Economic Symposium in Jackson Hole, and we've got some information from that with Jerome Powell and meeting with the other economic leaders and central bank leaders. The biggest takeaways are that they could keep raising interest rates, that they're saying that if they do not see the substantial rate of decreasing of inflation, that they could keep raising those interest rates and keeping interest rates higher. That we had some commentary coming out of that saying that they would rather risk tightening too much than not tightening interest rates enough. And the reason why is when you're dealing with interest rates, it's like a boulder on a hill. And so pushing up those interest rates, you're trying to tighten the monetary policies in the United States. And it is a heavy load and it takes time. And you've got to do it inch by inch. You are pushing that boulder up the hill. And then you have this lagging data that comes in behind because the effects of getting that boulder up the hill, it takes time for that to come through. And Jerome Powell even spoke about that we're still waiting to reach all of those economic cycles and all of the effects of raising those interest rates. So they're being really cautious right now, but it takes a lot of time. Now, say if they need to reverse the strategy, if they need to start flooding the system back with money, if they want to go quantitative easing again, then they can just let that boulder go and that momentum will roll down the hill. What was that back in 2000 in the COVID time period where they raised interest rates 2% on a Sunday night? So you can't raise interest rates by 2% in one night, but that flip of the switch and that turnaround can happen immediately. And the feds can't talk about those types of strategies either because the market will bake that into the future, which we can see the bond market has already baked in another rise of interest rates. We've hit the 2-year bond yield is up to 5.08%. It hasn't been this high since the mid 2000s, since the dot-com bubble. And so that's a big deal too. When bond values go down, that's when the yields go up. So after that information last week, the stocks rallied a little bit. The S&P and the NASDAQ, they were up. They broke a 4-week losing streak. But then the bonds, they were like, oh my goodness, not another interest rate hike. Okay, well, we're going to tighten up a little bit more. And then that inverted yield curve got even more inverted. So a lot of the bears out there, they're seeing that as a little bit more risk, looking at the potential of a recession because they really look at that inverted yield curve going into recession. But we've got some more information coming out this week, and this week's a big week on the jobs. Now, the jobs data is always lagging. But this is one of those scenarios where good news is bad news and bad news is good news. So we've got information coming out on Tuesday and Friday, and the big one's Friday morning. And we have job creations on Tuesday, and then we have the total jobs market on Friday. But what we're hoping to see is just slightly under expectations. We want to see those jobs go down a little bit. That's the two commands that the Federal Reserve that Jerome Powell has is maintaining our jobs and maintaining inflation. And so we don't want to break the system on jobs. We don't want to see a drastic, sharp decline. But if we can come down under expectations of job creations, come down under expectations on the strengths of jobs, then that's going to pull some pressure off of the feds of continuing to raise these interest rates. If jobs come out strong and we have a great jobs market, then I wouldn't be surprised to see stocks fall because the expectation of raising interest rates just went up even more. And the market and economists are already starting to bake in at least one more interest rate hike. Some other of the economic data that we're seeing is the durable goods sales have gone down. It's down about 5.2%, which is a big deal, but that's also what the feds want. So that's all expected. That's what we're looking to see. We're seeing even more turmoil internationally through Europe, through China, and inflation's getting a little crazy out of there, or stagflation in China. We're not seeing that contagion. We're not seeing that affect the U.S. as much. We've never been kicked into a recession because of international economic turmoil before. So we hope that stays steady. Oil, we've seen oil come back down to $80 a barrel. It got up to $84 a barrel, which is pretty high. And what really has me timid with that information is our next CPI data. So September 13th, that's CPI day. Should be a national holiday now every month, but CPI day, September 13th. And oil can raise inflation. The cost of transportation, cost of manufacturing, anything made out of plastic, oil, cost of travel, oil has a big part in that, and that could raise inflation to that point, and that CPI, that consumer price index. And if we see that raise of inflation on September 13th, that could really affect what the Feds are going to talk about on September 20th, because that's a big Fed meeting. And that's not just big of what they're going to do right now, but they're going to start talking on what does 2024 look like? What is the trajectory for next year? It's a presidential election year. We've been pretty tight on the monetary policies this year. Are we going to start lowering interest rates? Are we going to stay steady? Are we going to raise it a couple more times? And so that is a big day, and that CPI data on the 13th can affect that, and then the jobs reports this week can affect that as well. So we've got some big catalysts coming up. We're going to be paying close attention to it, so stay tuned into Kent's Corner, and I'll even see if we can get a bigger brain than mine to come on and see if we can break down this information even more tactically. So again, if you have any questions, reach out, make a comment, send us an email, and we're happy to help answer any questions. And please give us a like on this video and share it with your loved ones. Thank you so much. This is Kent with Kent's Corner.